Hello and welcome to our first economic update for 2018. Today you'll hear from our global economist Chris Watling from London, and he'll be talking about the key trends that have emerged in the early part of this year and this concept called melt-up, which a lot of investors around the world are concerned about, that the market has probably got ahead of itself in the early part of 2018. And without any further delay, let's hear from Chris from London.
Some of the great stock market legends have come out with comments. I'm thinking of Jeremy Grantham out of Boston from GMO Woolly, who's been around an awful long time, a legendary value investor. I'm thinking of Bill Miller, one of the great outperformers of the S&P over a number of decades. All these great investors coming out with the idea that the stock market is likely to melt up. And of course, it's important to remember, despite the valuation you see on some of the PE ratios on the stock market, I'm thinking particularly of the major US markets, despite the valuations there, which are really near record highs, frighteningly high, despite that, bull markets, a lot of the gains in bull markets are made in the last year or two. There's outsized gains at the start of a bull market and outsized gains at the end of the bull market, hence the comments about melt-up that we've had from Miller and Grantham and others. And of course, it's very hard to disagree with that sentiment. I wouldn't buy markets today if I wanted to time my entry point to the sort of day or week. I think tactically, on a week-by-week basis, they're probably a little bit overcooked here, and I suspect we'll see some sideways action for a month or two, or maybe a bit of give back in the major global stock markets. But having said that, I think it's difficult to disagree with that melt-up idea. If I look at our indicators, it shows me that liquidity is plentiful. It shows me the risk of a US recession in the near term is very low. And I don't see any obvious shocks. Of course, by definition, a shock isn't always forecastable, although some of them are. So I would say the melt-up concept is totally plausible. I certainly think equities will do well this year, and it will be worthwhile continuing to be overweight Western equities versus bonds and other assets in a globally diversified asset allocation portfolio. So we favour equities, we're overweight equities, particularly developed market equities relative to other asset classes. And, of course, synchronized global growth is helpful, earnings growth is helpful, but there are risks, let's not forget that, and we spend a lot of time monitoring those risks. And the risk can be characterized in a number of ways, but one way I like to do it is to think about the sort of key characteristics of this cycle since the global economy started expanding again in 2009. And those risks include things like what I call pass the debt parcel. The world's got more debt than it had in 2009 and 2007. More debt to GDP, more debt in absolute terms. The world's more indebted. Bits of it have deleveraged a little bit, but in aggregate there's more debt around, so the world is more sensitive to interest rate movements higher. So we need to watch that closely as central banks become more confident that they can raise rates. Let's watch the effect on liquidity, watch the effect on the sort of canaries in the coal mine economies, as I call them. So that's a key theme of this cycle. With that, of course, with that more debt, we have more zombies. More companies that are zombies, that can't really pay their own interest payments, that are hanging on by a thread. The corporate base in America, if you analyse the listed corporate base, we reckon about 12% of companies are zombie, up from sort of 1 or 2% 15 years ago. It's very high numbers, and that is America's typical of much of the rest of the world. So the zombies is a theme, the debt's a theme, and the emergency monetary policy that we're still on is also a theme. Let's not forget interest rates across much of Europe and the Eurozone are negative. I mean, before we had this, and a few years ago, this was unheard of, full stop, in history over several hundred years. So let's not forget the context of what we're in. There are risks associated with this cycle, but as always, liquidity is key, and liquidity looks good, and the US economy looks good, and that's key as well. So we remain overweight equities on a strategic basis, a little bit nervous over the next few weeks, couple of months, tactically, but strategically remain with it. And equities is our favourite asset class, and overweight that against all other key asset classes. So happy investing. Welcome to the first update by video. I hope it's useful, and more of these to come over the coming months. Thanks very much.
Thank you, Chris. That information was very, very useful. For clients that want to ask any questions about the impact of recent market events on their investment portfolio, please get in touch with us.